Hello, everyone, and thank you for joining today's webinar presented by Altfest Personal Wealth Management. My name is Jesse Frayling. I am the Director of Retirement Plan Services here at Altfest, and I will be your moderator for the webinar. The title of our presentation today is The New COVID Stimulus Package, and we'll discuss important changes both for businesses and individuals as a result of the COVID 2.0 legislation. We wanted to thank our clients and guests for taking the time to attend the presentation, and we're so glad you have tuned in today. Now I'd like to introduce today's speakers, Ekta Patel and Ryan Graham. Ekta is Altfest's Director of Financial Planning and is also one of the longest tenured directors and advisors at the firm. Ryan is a senior financial advisor here at Altfest, and as a chartered financial analyst, in addition to being a certified financial planner, Ryan serves on both the firm's investment and financial planning committees. We will finish with a Q&A at the end of the presentation, and if you have questions during the webinar, please feel free to type them into the chat box on the right-hand side of your screen. We will do our best to answer all questions live during the webinar. However, if we don't get to your question, be assured that we will follow up with you individually over email, certainly. With that, I will turn it over to Ekta to begin the presentation. Ekta?
Thank you, Jesse. Good morning, everyone. I hope you're doing well and you and your family are safe and healthy. Thank you for joining us today. In today's webinar, Ryan and I hope to share some key factors that hopefully make you better prepared if you're planning to apply for any programs through COVID 2.0 legislation. More particularly, we'll be focusing on changes applicable to businesses. I'll go over the Paycheck Protection Program, and Ryan will go over the Employee Retention Credit and changes that are applicable to individuals. So let's get started. I mean, we know from our experiences working with several clients that this process can be intimidating, and particularly for small business owners and self-employed individuals. In this particular, specifically in this bill, there is about $284 billion set aside for Paycheck Protection Program loans, PPP loans. Now, this bill allows for those who have not applied for round one yet or were rejected in round one to reapply again. So if you have not done so, you can apply for round one, and the qualifications for those are largely the same. However, by contrast, if you have received round one loans and need additional capital, you may qualify for round two as well. However, the qualifications for there are more stringent. So I want to focus on some of the basic eligibility and qualifications between round one and round two, differences in round one and round two. So who's eligible? The eligibility for round one and round two is pretty similar in the sense that small businesses, nonprofit organizations, sole proprietors, independent contractors, are eligible. This was same as round one. However, the size of the companies shrinks. So for instance, in round one, any business or nonprofit with less than 500 employees were eligible. Here in round two, it's less than 300 employees. This second and a very important difference is in round one, you did not have to show a reduction in revenue if you're applying for round one, but round two, there is a requirement to show reduction in revenue to be eligible, and that is a business must have experienced a 25% reduction in any given quarter during 2020 compared to the same quarter in 2019. So you look at all the quarters in 2019, 2020, and find a quarter in 2020 that has a revenue drop larger than 25% or larger. Now, keep in mind, when I say revenue drop, it's gross revenue, it's not net. And another thing, which is very important, that if you're applying for round two, the PPP loan amount that you received from round one does not count, again, does not count as part of the gross revenue. So that's an important thing to remember. Another thing, what I found that people should remember, that if you're applying for round 2, then you must have used your round 1 loans. So keep in mind that that is a requirement, that you must have used round 1 loans before you apply for round 2. So you can see that you will have to show comparative statements now. That means businesses will have to generally be prepared with 2019 tax returns, profit loss statements, payroll information. So you'll have to closely work with your accountants to get this, get ready for application for round 2. Another difference between the first round and the second round is the cap of the maximum allowable loan amount. In round 1, that was 10 million, but in round 2, that's been reduced to 2 million. So now the new cap is 2 million. Again, the reduction in the cap, the reduction in the size of the company, all that is done to make sure that more of a small businesses get this funding that are in need and are struggling in this difficult times. There was also a clarification made on covered period. Now, covered period is the period during which you can use the loan amounts. First, it was 8 weeks, then it was 8 or 24 weeks. But the round 2 stimulus clarifies that the businesses are allowed to select any period between 8 and 24 weeks, and that is applied retroactively. So that will apply to round 1 loans as well, that any period you could use between 8 to 24 weeks. Let's look briefly at a calculation of if you're applying for round 2 loans. So there are 2 options. The first one is you can calculate average monthly payroll over trailing 12 months times 2.5. So if you're applying now, you can use the trailing 12 months from now till February 2020 and then multiply by 2.5 times. Alternatively, you can use average monthly payroll of 2019 and then multiply by 2.5 times. Now you should look at both the possibilities to get the maximum possible loan. Again, remember round 2 is capped at 2 million. So if it's over 2 million, you are only eligible for the 2 million component. Now let's look at eligibility for forgiveness. For the loan to be forgiven, there is a preset formula to follow. It is at least 60% of the loan amount should have been used for payroll expenses, and remaining can be used for non-payroll, but it cannot be more than 40%. So you can go over 60% for your payroll expenses, but for non-payroll, you cannot go over 40%. You can see here on this slide, I've listed the payroll and non-payroll expenses. Payroll expenses are in green, and non-payroll related expenses are in blue. One thing that this bill did is expanded the list of eligible forgivable expenses. So if you look under round 2, you will see number of expenses are added. The top 4 are non-payroll related, and the last one, group insurance, is payroll related. And that group insurance is any expenses related to group health, life, dental, vision, etc. that can be counted under payroll formula. Now, one difference here is that you're looking at this and there are more expenses added under non-payroll category than payroll category. So you might think that you have more expenses so that you can use your loan for. However, keep in mind the non-payroll is capped at 40%, and you cannot go above it. Now, if I was a business owner, I would be looking at this list and thinking, well, gee, if I had known that these expenses can be applied for the loan to be forgiven, then I might have qualified for higher loan amounts in round 1. So there is some good news for people who may want to qualify for larger amounts. You can amend your round 1 application if you think this newly added categories could get you larger amounts. So that's one good news about this. So moving on, One of the biggest problems that we encountered, that as soon as round one borrowers started receiving loans last year, the IRS came with clarification or notification rather, which concluded that the expenses paid with the PPP funds would not be tax deductible. So on one hand, you have this tax deductibility, which they're taking away. On the other hand, they're telling you that here's a PPP loan and that will be forgiven. So really it's a wash because they took away the tax deductibility. However, this bill clarifies and fixes the problem by allowing to deduct expenses paid using your PPP loans. So here, and that applies to both round one and round two. So that's good news. Some of the deadlines to keep in mind is if you're applying for round one, it's March 31st, and again, it's the same date for round two. Now, if you're applying for forgiveness, you can start applying 10 months after your covered period ends. Remember, the covered period is between 8 and 24 weeks. So once that period ends, 10 months after, you can apply for forgiveness. One thing to keep in mind that in the new stimulus package, the application process for forgiveness of loans below 150,000 is much simplified. So the form's really simple. You're not required to submit any documentation. So, and there are no complicated computations required to apply for forgiveness. So hopefully that would be an easier process for people who are applying, who had gotten smaller amount of loans. I do recommend to keep all the documentation for 3 years or more, just in case, if you're audited, to make sure that you have all the documents in place. Now, where can you apply? Same as round one, most SBA approved lenders and banks, if you already got round one loan through your existing lender, you should go with them. And if you're applying for round one, at least start with your existing lender. And if that's not possible, try credit unions, smaller banks. The reason I say that is because in this new stimulus bill, portion of the 284 billion is set aside for community financial institutions, small banks, and more specifically for businesses that have less than 10 employees, and women-owned and minority-owned businesses. So this is very important. If you fall in one of these categories, I would suggest you look for smaller banks. Maybe you would get the funding faster. Now, we often get a question, will the PPP money go fast? And with that, the first time there was a lot of chaos around it, but here is just to give you some perspective that of the 525 billion that were issued in previous rounds, 105 billion loans were made which were over 2 million. So majority of the loans went to businesses that had requirements of 2 million and lower. Also, the revenue decline requirement, remember the 25% drop in the revenue decline requirement, that also limits some businesses from applying for round two. So they've been very careful this time around so that the money goes rightfully in the hands of smaller businesses, and it's not favored toward larger businesses. I can't emphasize more that if you are planning to apply it, please apply as soon as possible. In a sense, really, this is free money given by the government, and to really sustain small businesses in this difficult time. So if you have any questions about further details of the PPP, feel free to get back to us. But with that, I will turn it over to Ryan. Thank you for listening.
Thanks so much, Ekta. I think I'll just add, I believe the last time I was looking at it a couple days ago, around 100 billion has been already loaned through the PPP program. So we're at a pace of about a little over a third of the available funds has already been doled out. So like Ekta said, assuming you qualify, it's probably a good idea to look into applying sooner rather than later. So I'd like to transition our presentation to a section on the employee retention credit, as well as a section that pertains to the benefits from the recent legislation for individuals. So this employee retention credit is mainly available to businesses, and you may be thinking, well, I didn't hear much about this last year, and there's a good reason you did not. If you received a PPP loan last year and you expected to have it forgiven, the employee retention credit, or ERC, was not something that was even available for you to take advantage of. Recently in this legislation, they have now made it fully available to anyone that already received a PPP loan. So this is potentially a lucrative tax credit that could now be available to you if you are a business owner and have employees. There's an important distinction between the old ERC, which would apply to last year, 2020, and the new ERC, which would apply for the first half of this year from January until mid-year. So there are two different credits with different potential values to you, which I'll review later on. And there are also two separate eligibility requirements. So for the old ERC, in order to be eligible, you either needed to witness a greater than 50% drop in gross receipts during a quarter during 2020 versus the same quarter in 2019 in order to be eligible for the ERC during that quarter. Alternatively, you could be eligible if your operations were either partially or fully suspended by a government order. But if you're eligible under this criteria, only wages paid during the suspended period, whether your workers, your employees were actually working or not, would be eligible for the credit. So the eligibility criteria number one probably provides you more value when it comes to this credit. So once again, flash forwarding to the new ERC, which applies to the first 2 quarters of this year, the eligibility requirement is less stringent. There's a lower hurdle to jump over. So the gross receipts can have dropped greater than 20% versus the 50% for last year. And that would make you eligible for the ERC this year. And once again, comparing to the same quarter in 2019. Similarly, the eligibility during a partial or full operation shutdown by government order remains the same, but I would say it's probably less likely, depending on the business type, that this would apply this year compared to last year. So what are we talking about as far as the value of this credit? On the next slide, I'll just kind of give you a sense for what this could mean to you. The old ERC for last year is a credit of 50% of qualified wages up to $10,000 per an employee for the entire year. So those are the most important words there, for the entire year. You're capped at $10,000 per an employee for the entire year. So this is potentially a $5,000 tax credit to you as an employer per an employee last year. Meanwhile, the new ERC, this is now a 70% tax credit on qualified wages up to $10,000 per an employee, capped at that $10,000 now per quarter. So potentially, this is now 70% tax credit on $20,000 of wages this year for the first and second quarter, and 70% of $20,000, that's $14,000 possibly per an employee as a tax credit that, if your business is eligible, that you could take advantage of. So what are qualified wages? These are wages defined by the Internal Revenue Code. Things like W-2 wages is like a perfect example there. Also, for the new ERC, this would include health insurance or plan expenses that you're paying on behalf of your employees. And this could be important and come into play, especially if last year you had to furlough employees due to the uncertainties around the COVID pandemic, and maybe you kept paying their health insurance. So you would still be able to claim this type of credit against those expenses, even if you were not paying wages to your employees during a period of shutdown. Now, very important thing to note here, which is different than the PPP, is that the expenses for which you're using this credit against, the wages that you're using the credit against, do not remain deductible. So unlike the PPP, where all those eligible expenses that you're looking to get, a loan for that is forgiven, this one is not quite as valuable because to the extent you're using the credit, so for example, if you use $10,000 of wages for the credit, you would lose $10,000 of deductions related to those wages. So depending on your tax bracket, you might be paying more taxes, but net, when you're looking at your tax bracket versus the benefit of the credit usually far outweighs any deduction that you may be foregoing. So this is certainly something you want to be looking at, even though you're going to lose the deduction. And so how do you go about this? You want to work with your accountants, and assuming you're eligible for last year, you'll want to file a payroll tax form 941, an amended one, to go ahead and claim this credit for last year. And then this year, similarly, you'd use the 941 because this is a payroll tax credit. And assuming you expect to be eligible for the first quarter and second quarter, you can actually file Form 7200 to get an advance on this credit. So if you're confident you'll be eligible, you can actually get cash now versus waiting to file the Form 941. So let's move on to the next slide and just give you a sense for how do we coordinate these. So let's assume I have the PPP loan. I'm looking to maybe take advantage of the ERC credit. Maybe even if you run a practice and you bill Medicare, maybe you've received some HHS provider relief funds. So the most important thing when you're coordinating all these is you cannot double dip on the same wages. So you cannot apply for forgiveness on certain wages through the PPP and also use those same wages for the ERC for that tax credit. So that's the first thing to just always keep in mind. There are some strategies, considerations to think about here. One thing that is also important to note, where we're seeing in reality what this would look like, but the tax credit for the ERC, the wages for that actually take priority over the PPP, but it seems you can elect out of the ERC if you want wages to apply for your loan forgiveness through the PPP. And the actual practicality of this is kind of yet to be determined, but something to keep in mind. All right, so what are some strategies here based on what we know? One to consider is if you're looking to be eligible for the ERC, that tax credit that could be lucrative to you, and it looks like your business is kind of on the edge of qualifying with that 20% gross receipts or revenue reduction, you may consider whether it's possible and worthwhile for you to defer out some collections past the first quarter of this year in order to retain eligibility for that ERC credit during the first quarter. So that's one thing. The second thing is, for the PPP loan forgiveness application, you'll probably want to look to maximize those non-payroll expenses in that application. So ECTA, was very clear on what those were and how it's capped at 40% of your forgiven amount. Well, maybe you try to shoot and hit that 40%. Don't try to claim as many payroll expenses as possible or wages in that PPP loan application, because you want to use those for the ERC. So that's something to consider. And then finally, ECTA, it made it clear that we now have some flexibility with choosing a covered period for that PPP loan forgiveness. So maybe depending on how the guidance comes out, maybe you try to keep that covered period as short as possible in order to maximize the amount of time that you can then claim the ERC. So this is kind of still in the works with guidance on how you can actually claim both, but those are some things you should be considering. Next, let's take a look at what does it look like to qualify for the ERC. So in the top chart, you see an example of a healthy business in the first quarter that suddenly experiences a significant decline in gross receipts in the second quarter of 2020. So you can see there it's about 2/3 lower in revenue. So it's very clear that they meet that hurdle to qualify for the ERC in this quarter because their decline exceeded 50%. The next quarter, Q3, you can see things kind of bounce back. They're still down as a business, but it's not above that 50% threshold. But because they qualified in the prior quarter, they continue to qualify for the ERC until their revenues exceed 80%, which they did in this quarter. But by nature of qualifying in the prior quarter, that continues to make them eligible in Q3. And now, because they exceeded that 80% threshold, they're no longer eligible in the fourth quarter for this credit. Let's take a look at what this looks like for the new ERC for this year. You can see here in the bottom chart, in the first quarter, this business has experienced a 25% decline in gross receipts compared to the same quarter in 2019. That makes them eligible in the first quarter. By nature of being eligible in the first quarter, the rules have a look back provision. So you can say in the second quarter, I want to look back to the first quarter and use that quarter to determine my eligibility. So even though the business recovered fully in the second quarter, because they were eligible in the first quarter, they can also claim the ERC in the second quarter. This would work in a similar manner for Q1. If you're ineligible in Q1 because you didn't experience a revenue decline that was significant enough, you can look back to the fourth quarter and say, was my fourth quarter 2020 down more than 20% compared to fourth quarter 2019? So as you can see, this gets a little nuanced, but we want to make you aware of some of this so you can speak with your accountants and with us to just kind of see where you might be eligible. Alrighty, so let's just move on to another couple examples of things small businesses should be considering before moving on to individuals. So for those of you that may have applied and received an economic injury disaster loan or EIDL last year, those loans now are fully available to you to be for basically free money for whatever advance you received up to $10,000. It no longer offsets the forgiven amount on the PPP loan application. So that is now kind of separate and distinct and does not reduce the amount you can get forgiven in the PPP. There's also some additional EIDL loans out there for businesses a little bit more targeted that have experienced revenue declines of greater than 30% and are in low income areas. So if that includes you, it might be something to look into another advance. You also want to keep in mind that paid sick and family leave credits were extended through the end of March. So if you have any of your employees that are either taking care of somebody that's sick or are sick themselves and you're paying them, those are kind of full credits against the wages paid. And also the one part of the prior legislation is now extended until 2025, which is the ability to pay employees tax-free up to $5,250 for them to pay off their student loans. So this would be tax deductible to you as a business owner and tax-free to your employees. So really a win-win for both sides, assuming they use those funds to pay off student loans. And then finally, the meal expense deduction after the Tax Cuts and Jobs Act was reduced to 50%, but now that is back up to 100% deduction for meal expenses, like going out to a restaurant, as part of your business day to day, and that's extended for 2021 and 2022. So let's move on to what the legislation means for you personally as an individual, or maybe family and friends who this may be applicable to. So a couple newsworthy items that you may have seen out there. One was for anyone on unemployment benefits, there was an additional $300 weekly kicker that was extended through the end of March. So, additional supplement to the state unemployment benefits there provided by the federal government. Another, big newsworthy item was the recovery rebates, which this round were set at $600 per eligible individual or child. And we included this chart here, which gives you a sense of, what does it look like to be eligible? So if your income was higher than the threshold in both 2019 and 2020, you would be ineligible for this. So you are phased out if you're an individual earning taxable income of greater than $75,000 or if your adjusted gross income as a married couple is greater than 150,000, so you're phased out. However, if your income was higher than that threshold in 2019, but subsequently is now lower on your 2020 return, then you're still eligible for the rebate. You're just going to have to receive it and claim it for your 2020 return. So that's that yellow box down at the bottom left. However, if your income was lower than the threshold in 2019 and subsequently became higher in 2020, you're still eligible for the rebate. It's probably already paid to you by now, and you don't need to pay it back even if your income exceeds that threshold. So these are some things to keep in mind. And then finally, on this slide, for charitable giving, a few things were extended from last year. One was the above the line charitable deduction, which last year was capped at $300 per individual tax return, regardless of whether you're married or filing as a single individual. Now for 2021, they have made that deduction $600 for a married couple filing jointly, and while it remains at $300 for an individual. So, a small amount that you could claim on cash donations made to qualified 501c3 charities, and these cannot have been made directly to a donor advised fund or a private foundation. And then lastly, there was a 100% charitable deduction against AGI allowed on your Schedule A. That cap is usually lower for cash donations at 60%. So this is another thing that was extended, but depending on your situation, may not be something you want to do to fully offset your tax liability for strategic reasons. So next, a final slide just for individuals here. There were a few things added to this recent legislation. One was your employer can now extend the use of your FSA flexible spending accounts for healthcare dependent care into the full new year. So instead of having like a deadline of March, for example, you can now get that extended through the end of this year, 2021. Another thing is that the lifetime learning credit now has a new phase out range that aligns with the American Opportunity Tax Credit. So for some of you, that may mean that you are now eligible for this credit for education expenses when you were previously were not. Notably not extended, one was the relief provided for early retirement distributions from retirement accounts. So that penalty-free distribution was not extended into this year. Another thing which actually more recently President Biden did actually extend through executive order, but was not included in this bill, was student loan relief, a pause on those on certain student loans. So that was actually extended until September by President Biden, but was not included in this bill. And then lastly, on things not included, one for many of our clients, which is important, is required minimum distributions on your retirement accounts were paused and not required for last year, should you want to take advantage of that. And this year, they're once again required. There's no indication that those would be waived in future legislation, and there was nothing included in the recent legislation on that front. And I think it's just important to say we should stay tuned for additional stimulus, how this could impact you and your situation, how tax law changes could even potentially impact you. So there's a lot in the pipeline right now. Potentially over the next few weeks or several weeks, we may see an additional stimulus bill that we'll be keeping our eyes on, and of course, anything that might be relevant, we'll be making that information available to our clients as well. So Jesse, I think that's it for me, and we're happy to transition into Q&A if you'd like.
That sounds great, Ryan. Thank you, Ryan and Ekta, for an excellent presentation on this very important topic. We did receive a few questions that came through the chat, so we thank you, everyone, for attending and also submitting your questions, and I'll start those now. The first one is, do I need to apply for PPP loan forgiveness before taking a second PPP loan? Ekta, since this was covered a little bit in your section, I'll let you answer this one if that sounds good.
Sure. No, if you received the first round of PPP loans, you do not need to apply for forgiveness. for applying for the second round. However, you must have used the amounts received in the first round before applying for the second round. So forgiveness is not required, but making sure that they are all deployed, the round one money is deployed, is required.
Thank you for making that clarification, Ekta. The second question we received is, the amount of forgiveness of a PPP loan depends on the borrower's payroll costs over an 8 to 24 week period. The question is, when does that period begin? Ekta, let's throw it back to you.
Yeah, the period starts as soon as the money hits the account. So for instance, the lender has about 10 days to release the loan amount to you as once you're approved. And once the bank releases that PPP money to you, that's the day your covered period starts. And from then on, you have anywhere between 8 to 24 weeks to use that amount.
Thank you again, Ekta. Third question we received, are self-employed individuals eligible for the employee retention credit? Ryan, would you like to answer this question?
Sure thing. So as a sole proprietor or self-employed individual, you are the business. If you do have employees, you will be eligible to claim a tax credit on the wages paid to employees or independent contractors. However, unlike the PPP loan, your net income or your income from the business would not be considered employee wages for the purpose of the tax credit. So unfortunately, kind of the answer is no, but if you do have employees, even if you are self-employed, then you could potentially claim this credit for those wages paid.
Another great clarification, Ryan. Thank you. You mentioned a change to the lifetime learning credit. Can you elaborate on how that benefits me if I have children in school? Great question. And Ryan, back to you with this one.
Yeah, sure. There's, I think, a lot to unpack here with the two different types of education credits out there. But for the purposes of this call, the lifetime learning credit, that one, previously there was a phase out range that was much lower, and I think I have it here next to me. It was right around 138,000 was the phase out range for a married couple and 69,000 for a single person. However, that was now bumped up to closer to like 180,000 for a married couple and 90,000 for a single individual. So you have much more space if you are higher income and maybe you already used the American Opportunity Tax Credit, which is capped at 4 years per child. So, it's very possible you could now be eligible for a credit you were previously not, even if you are higher income and have children in college or, graduate school or wherever they may be.
Thank you, Ryan. The last question it looks like we received is this. The question is, should payments that an eligible borrower made to an independent contractor or sole proprietor be included in calculations of the eligible borrower's payroll costs? Ekta, let's put this question to you since this was in your section.
Sure. The short answer is no. Any amounts that you paid to independent contractors or sole proprietors, that should be excluded from your payroll calculation, payroll cost. However, the self-employed people and sole proprietors, if they are eligible, they can apply on their own for PPP. So that is exactly the reason why you cannot include their what you paid in your actual cost. You want to double dip.
Certainly makes sense, Ekta. Thank you and Ryan again for an excellent presentation, and thank you again to all of our clients and guests for attending and for asking great questions. We greatly appreciate it. We certainly hope this presentation was helpful and informative to everyone. And of course, as always, if you do have additional questions that come to mind, we certainly encourage you to reach out to us and speak with a member of your wealth management team. Thank you again to everybody. This concludes our presentation, and we hope everyone has a great rest of their day.
Thank you, and be well.
Thank you, everyone.